We're going to talk about affordability. We're going to talk about how to be a ready buyer, and really get into the nitty gritty of what goes into that process. Like how much can you afford, and so how do we as lenders calculate the ratios and so forth. So for this piece, our presenter is going to be Jesse Stein. So Jesse Stein is a loan officer with UNFCU. He has over 22 years of experience in residential lending. He works with 1 to 4 family buyers and condos, residential. And like all of our loan officers, we can lend in all 50 states. So if you're buying a home in Florida or California or Boston or New York market, we can help you across the country. Jesse is in the the greater Boston market, but again, he can help you wherever you are. So with that, Jesse, take it away.
Thanks, Mike. Next slide, please. So we're going to get into the nitty gritty of underwriting and approval of a mortgage. Like, what do mortgage lenders really want to know to make that determination, and how do they approve loans? So let's start with income. That's a big one. Income is defined as gross income or pre-tax income for W-2 wage earners. So if the applicant owns less than 20% of the business that they work at, they're just gross W-2 wage earners, and we use that pre-tax number for qualifying. If self-employed, and that's defined as owning 20% or more of the business, we use a 2-year average of net income. So that's Schedule C businesses, File 1120s, so 2 years of the number after deductions. So net income is considered. Also for commission-based earners, it's a 2-year net average. Now, debt to income is a calculation that takes into consideration monthly debt obligations, things like credit cards, student loans, auto loans and leases. Really, anything that's going to be reported on the credit report is monthly debt. We take the total of the monthly payments, add what Janet referred to earlier, the PITI. Once again, that's principal, interest, tax, and insurance on the loan. The gross income for W-2 wage earners, and the net income, is divided by that debt plus PITI, and that's how we arrive at the debt to income ratio. And our mortgage guidelines have maximum debt to income ratios for different programs. Just skipping down to the bottom of the slide, it says low moderate applicants can put less than 3% down. That's our first time buyer program here at UNFCU. And just as an example, the max debt to income percentage for that loan program is 45%. So in other words, you can have 45% of your monthly income going out to pay the bills and the monthly payment on the house. So credit scores, let's talk about those for a second. The credit scores are derived by an algorithm from the repositories. Those are the 3 entities that basically house all the data on people's credit histories and credit repayment timeliness. Those are TransUnion, Equifax, and Experian. They all have websites. You can go on there. You can freeze your credit, unfreeze your credit, etc. Those 3 entities are who we rely on through our credit reporting vendor to generate credit reports and get the scores. So those companies have a scoring system in a range from 450 to 850. The score is based on history, length of time, timely payments, available credit. Lots of factors go into credit reports. Again, good example, our first-time buyer program. We have a minimum FICO credit score of 680 for that product. By middle FICO score, I'm referring to the middle score between the 3 scores. So we take the TransUnion score, the Equifax score, the Experian score, and use the middle of that. As long as that's 680 or above, that qualifies. Let's talk a minute about down payment post-closing reserves. So we look at assets, as Janet talked about, submission of bank statements and other financial documents. We want to see 2 months payments equivalent in post-closing reserve for that first-time buyer program. So what that means is we just want to see on the bank statement that it's not the last dollar the applicant has is going into the down payment and the closing costs. They have to have a little savings left over. We term that as post-closing reserves. Next slide, please. So the theme here is keep it simple. We want to make sure that the application process goes really smoothly or as smoothly as possible. And here's how to do it. Avoid credit pulls if possible by entities like credit card companies, retail stores that want to offer a discount in exchange for getting a credit card. Credit pulls show up on the credit reports that I talked about on the last slide. We actually, and all lenders, want explanations for these credit pulls. So it'll save time later if we have fewer credit pulls before you apply. Moreover, the scoring system that I referred to in the previous slide takes into account credit pulls. So if people have their credit pulled a lot, that can actually hurt credit scores. Let's talk about jobs and careers. Job changes can be a great thing. There's lots of opportunities for movement and different types of businesses to work in. Here's the thing, though. Job changes can impact the mortgage process. So have a conversation with the loan officer if during your pre-approval, pre-qualification process, you get a job opportunity to move. Maybe it's a good thing. Maybe it won't hurt your application, but better safe than sorry. Example of what could hurt an application is going into self-employment. Because again, with self-employment, you have to have a 2-year history. So avoid job changes if possible, or at least have a conversation with the loan officer about any employment change opportunities. Let's talk about deposits that show up on bank statements. So mortgage underwriters have at least a 2-month look back on financial assets and bank activity. Large deposits, anything over 1,000 that appears in that account activity, that has to be sourced. Please don't deposit cash into your bank if it's within that 60-day look back. Cash deposits are pretty much impossible to source. Big headache. So that goes back to keeping things simple. It's a great time not to make transfers between accounts, not to close accounts, not to open new accounts if possible. Again, and we'll keep going back to this, communication with the loan officer can really help with any needs in terms of banking, consolidation, transfers, etc., to see how it's going to impact things. Janet did a great job of explaining the monthly payment, but I'll just reiterate, principal and interest, that's the number based on what we call amortization. So a loan has a term, you have to pay it off, say in 30 years. The interest is accounted for in the payment along with the principal. And we escrow for things like property tax and homeowners insurance. Your realtor, like Lisa, can help with knowing, or at least guessing as best as possible, what the property tax is going to be going forward on a subject property, as well as if it's a condo, whether or not there's a condo fee. We don't escrow for condo fee, but it's good to know what it's going to be. We certainly take it into account in terms of qualifying. Next slide, please. So the initial LO call or loan officer call, I like to call it the back of the envelope call, because that's a time when you can really just have, there's no application in the system. You're just throwing around ideas and numbers. The loan officer can help understand what you can qualify for, just generally based on a discussion, informal discussion, about income, monthly payment, and down payment. So after that initial informal call, now you're ready to get pre-qualified, right? I always like to advise folks to opt out of trigger leads. Trigger leads are the marketing done by the credit bureaus I mentioned earlier. So Experian, TransUnion, and Equifax, for all their usefulness, they make a lot of money on selling the fact that people have their credit pulled to my competitors. The competitors, then seem to like to spam the heck out of my clients. So just to save yourself that unwanted spam, this can be phone calls or emails, unfortunately, you can go to www.optoutprescreen.com and do that opt-out process. I always advise my clients to opt out of trigger leads before submitting the application. And that's the next step, is getting the application in. As Janet said before, we can do a pre-qualification very quickly. That does involve the tri-merge hard pull credit report and just an application, but we can get into the pre-approval actually on the next slide, please. So the pre-approval is a full underwrite, even without a property. You can actually get a commitment letter from us without having a property under contract yet. This has a lot of advantages from my perspective. I think Lisa's going to talk more about, from the real estate agent perspective, the competitive advantage. But I like it because then my client has been fully pre-approved with a commitment letter. We've done all the heavy lifting without the stress of having a property under agreement. We've also addressed any potential issues. So I love it when my clients get fully pre-approved. It makes everything much easier, much lower stress, and really can help dig out any potential problems ahead of the game. Next slide, please. Another best practice, integrate your loan officer with your realtor and attorney early and often. It's great if those three players are all on the same page and have good communication. Even better if they've worked together before. One thing that I really appreciate in a client is responsiveness. I certainly am responsive. All of us here at UNFCU are, and we really enjoy it when our clients read emails, respond to emails, etc. There's a lot of exchange of information during the mortgage process, and there's going to be a lot of things requested. Even after a fully underwritten pre-approval, we're going to need things during the process in terms of timing, maybe follow-up documentation. So please stay in contact with your loan officer throughout. Next slide, please. A few more best practices. The slide regarding beware of fraud, that refers to wires. So during the initial home buying process, there's going to be deposits. So you're going to have a deposit when you put a property under agreement. Then at closing, there's going to be possibly more down payment needed. Sometimes people want wires for those deposits. A lot of closing attorneys want wires for the closing funds. It's really important to verbally verify the wire instructions. Why? Because hackers have developed incredible methods of replicating emails. They can make an email look like it came from a trusted source when it's really somebody putting in false wire details. So it's okay to get the wire details from your attorney, a realtor, etc., through email, but please verify them verbally after the fact. Homeowners insurance binders, have that conversation with your insurance agent early, because the binders or the homeowners insurance certificates are reviewed and approved by underwriting. And a good loan officer is always accessible for Q&A. What better way to segue to the Q&A from Mike Lomeo?
Jesse, thank you so much for that great presentation. From what you had talked about, and it seems a recurring theme from Lisa and Janet, the importance of and the benefit of having a pre-approval really seems to be evident here. So let me ask you a few questions came in, but like basically, like if I wanted to do that, like how does that actually happen? Do you send, is there a link? Like how do I actually initiate the request for pre-approval?
So going back to the first step of the discussion, we talk about that in the conversation when we do the back of the envelope number review. Then I send a follow-up email, talk about some of the terms of the loan potential, and spell out a little bit of that process. I put in the link for the opt-out pre-screen, and there's a link to the application in my email. I can take an application over the phone, but most of my clients seem to want to do the application on their own time. And we have a great platform for that through our portal.
And it's
The
convenient because you can do that whenever you want over the weekend or in the evening, right? And then you could pick it up and follow up with them from there. So that's really good to know.
We have about
Um,
90% of people want to do it that way. And then after that initial application, my list of supporting documents through a secure email. There's also a way to upload those through the application portal. And then from there, we have the material submitted to underwriting for that fully underwritten pre-approval.
and how long does that pre-approval last? Like once it's been issued and I've got it in my hand, I'm happy about that. How long does that last? How long is it good for?
Well, the credit reports are good for 120 days. So as long as we close on the transaction within 4 months of the credit pull, we can use the original credit report. Supporting documents like bank statements and pay stubs have a little bit shorter shelf life. Pay stubs, we probably be updating those about every 30 days. Bank statements about every 60 days.
So basically, somebody would, if that house search is taking a little bit longer, they should be prepared to send in a fresh pay stub or a fresh bank statement as the house hunt goes on and the pre-approval needs to be updated. So good to know there. Um, and then as far as the way people can own property, they talked earlier about it. Like I don't know, probably 90% of folks own their home as an individual, but some own it in an LLC or in a trust. So if I close as an individual, after the closing, can I then switch it to the trust or do I have to ask for permission from our servicing department?
Yeah, that's definitely a servicing call. It's really a better practice to work with your loan officer to provide things like an LLC, if that's how title is going to be vested. We can actually close in an LLC here at UNFCU, which is a big competitive advantage we have.
Yeah, not
Uh,
everybody does that, right?
that's right. Or they require massive deposits, et cetera, high fees. We do it with no additional fee. Uh, and then in terms of revocable trusts, same thing. Have the loan officer submit the trust paperwork during the initial underwrite,
Right.
because it's not necessarily given after it closes that you can do that.
And why would somebody do that in the first place? What would be the benefit of doing an LLC or a trust ownership versus as an individual? Why would people consider that option?
Well, this is where I usually make a referral to an estate planning attorney or an accountant or a business attorney. And I do have lots of those in my referral network, but I know enough to be somewhat helpful. There's certainly protections from liability, as well as estate planning in terms of planning for the future. Who's going to own the home after something happens to me? How are my kids going to take title to this house? How is it going to impact them from a tax standpoint? I'm not an expert necessarily in estate planning or tax preparation, but I do have some great partners that I work with that can address that stuff.
So, Jesse, that's a really good call out. I think two things from what you're saying. One is if you're going to take that kind of option, you want to consider it before you close, because afterward it's more complex to do it. But secondly, you really need to speak to your attorney about the pros and cons of that option and why somebody might choose to do it, because that's we're certainly familiar with it, but it is a little bit out of scope from just specifically the lending. I did want to go back to your conversation about the debt to income ratios and how we qualify people, and that's kind of where the number crunching comes in, right? So, like, if the debt ratio is required as 43%, so if I make $10,000 a month, $4,300, 43% is the number. Would the taxes and homeowners insurance and monthly maintenance fee on a condo be included in that number as well, in that 43%? Or is it just the
Yes.
mortgage?
No, that's a great call, Mike. I mean, the monthly homeowners association fee certainly does play into the debt to income ratio. So it's principal, interest, tax and insurance escrow, and HOA fee plus monthly debt obligations. That's the bottom line. Top line being income. That's how we arrive at that percentage.
That makes a lot of sense. And I guess if I'm shopping for a condo, that's one of the questions I might ask Lisa. What are the taxes, but also what is the monthly maintenance fee that we're looking at? Now, UNFCU, is a portfolio lender, so for the most part, we hold our loans. We don't sell them. We keep them and collect these interest and make service it. So we're long-term partners with our members on this. Are we limited to the 43%? I think you covered this, but can we go a bit higher if we feel the borrower can handle it and has the ability to make the payment?
Well, one of the things I love as a loan officer here at UNFCU is the flexibility of our portfolio lending, where we can, on a case by case basis, exceed the 43% up to 50%. Not sure about the first time buyer program, but certainly on our portfolio 6-year ARM product, we have some leeway up to 50%.
And then last question, Jesse, you've been great. Is if I am in that situation and I want to know, hey, can I go a little higher, and can, instead of 43, can I go to a 45 or a 48 even debt ratio? I need an exception on that. How does that work? Does it take a long time for me to wait to get an answer on that, or is that something I can find out up front and kind of get a peace of mind in the beginning of the process?
Another great thing about working here, Mike, is that we can get these things reviewed and approved during the pre-approval. So I can actually get a pre-approval done for somebody and get an exception on a guideline at the same time before they've even made an offer on a property.
Wow, that's huge, because again, we want to be as strong as possible, particularly in a competitive market. Jesse, this has been great. Good information there. We covered some broad strokes, but obviously we're available for more questions post presentation. If we can go on to the next segment.